Now, this is a rather important question. Who's the taxpayer? Is it always clear who the taxpayer is? Well, we were just talking about disregarded entities, and we said that even though the local taxpayer is that company X, G up top is now considered the legal taxpayer from a U.S. standpoint. Okay, so that's nice. There's some specific guidance in the regulations, and again, as I think I mentioned before, one of my purposes in putting together these slides is to provide a reference tool. So you've got an indication that 1.901-2F is where you find rules on who the taxpayer is. So again, hopefully that's useful to you as you do your background reading and other things. And this to me is a very interesting thing. I have no idea as to why, when the foreign tax credit was originally put into the statute, why, when they wrote regulations over time, why they focused so much on who has legal liability for the tax. Okay, why am I saying that? Why am I expressing surprise? Are there any other criteria that we might think of which could maybe be a way to decide who the taxpayer is?
Who actually pays the tax?
Yeah, that's another one, yes. Who actually pays the tax? That actually wasn't the one I had in mind, but that's absolutely right. Who pays the tax? In a withholding tax situation, the person who physically pays the tax is the licensee or the debtor that's paying interest or the company that's paying the dividend. So, yes, physical payment of tax is specifically indicated as not a criteria. It's really who has legal liability. Now, is there some other criteria that might have been relevant in deciding who the taxpayer is that we haven't talked about so far? Yeah, excellent. Excellent. Who earns the income? Is the taxpayer necessarily always, or the person who has legal liability for the tax, is that necessarily always the person who earned the income? When I was practicing in Hong Kong in the late 1970s, I remember having a client who was he was working for a major company, but he was fortunate enough back in those old days before women's liberation of having an income-producing spouse. And that income-producing spouse happened to be a non-resident alien of the United States. Okay. So she was not a U.S. taxpayer. He was. Now, I don't know what the situation is today. Maybe the Hong Kong government, has come forward in time. But back then, the legal taxpayer was the husband, even though it might be the wife's income. So, gee, if he's legally the taxpayer, it's not his income. We're not including that income in his married filing separately tax return. But under Hong Kong law at that time, it was his tax liability. If it didn't get paid, he's the one that would go to prison. And I don't think you want to go to prison in Hong Kong. Well, maybe today it's a little nicer. Anyway, you probably don't want to. So that was something that I had to wrestle with and look at and figured out in the end. Well, with the regulations and the law at that time, yeah, we could claim quite properly her tax, even though he's not the earner of the income. Now, this was in the 1970s. The law has been this way since presumably, I don't know, the 1920s, maybe the late teens. And finally, in 2010, as part of legislation enacted in this past August, there's been something that deals with this silly situation. Not necessarily with the husband and wife situation, but in the corporate sphere. And this is partly the result of having these check-the-box rules. Because it's easy to plan now to have one company perhaps be the payer of the tax and another entity, which is considered a corporation, to be the earner of the income and to separate the two. So there's now some rules which we'll get into a little bit more detail later, but there's some rules to try to deal with this separation. Yes?
I just have a question. It's kind of a off-topic question, but are those check-the-box rules, has that led to what everybody's talking about? The corporate loopholes where you can pretty much just avoid tax. Is that one of the reasons where?
I would say no from the standpoint of trying to avoid tax completely. From the standpoint of structuring legitimate businesses in a manner to minimize tax in the foreign countries where the operations are taking place, and to then defer as long as possible. In other words, until a dividend is paid. Gee, I'm never going to pay a dividend. So to maximize reduction of foreign taxes, and then secondly, maximize the benefit of this deferral from having low taxed earnings in a foreign corporation and not distributing them until until kingdom come, or whatever point it is. So in that sense, yes, but it's not the, I'd say, the more flaky variety of the basic tax cheating that I think is what you're probably referring to. In other words, where people are hiding money in UBS or other foreign institutions, that sort of thing. Okay, as you can imagine, a partnership is very often transparent, but not all countries treat partnerships as transparent for tax purposes. Some countries, in my experience, not that many, but some countries do treat partnerships as taxpayers just like any other corporation. So if you have that kind of a situation, there does happen to be a special rule that, of course, says that the partner is the one who is treated as the taxpayer. So it just allows for ease of treatment in this area. So this is a partner level issue as opposed to a partnership level issue. Okay, I think we've already talked about the fact that physical difference, physical payment, excuse me, doesn't change things. I think I had asked you, sort of in connection with this issue, to just take a look as preparation for this session at the IP licensing part of the case study. Does that sound familiar? Okay, that's encouraging. Okay, and let's see, in that, somewhere in here, we said that there was a, let's see, we had, let's say, when up here, we have when servers UK Limited, and it is going to enter into a license agreement.
The machine's not on.
Oh, yeah, thank you. Is going to enter into a license agreement with a Nigerian company, of course, that is unrelated. And it said what? There was, I think, a 12.5% withholding tax, and that 12.5% withholding tax paid on net basis. Okay, first question is, what does it mean when something is paid on a net basis? Anybody know?
Deductions are taken from the cost income. So deductions allowed or allowances are taken from the cost income.
Okay, that's fine. Now, why would I want to license something to you on a net basis, where the royalty is paid on a net basis? Any idea of why?
Are you referring to payments based on the profitability of the product, or?
Well, let's say let's say that it's a license that's a simple thing based on units of production. I mean, that's a good point about the fact that, yes, royalties can be based on something other than units of production. But let's just assume a simple thing. Why might I, as a licensor, want to license to you, who are, relatively speaking, unknown to me? Why might I want to license on a net basis instead of just agreeing to a gross amount subject to whatever withholding is in the country?
Is less than it's based on gross?
Well, the thing is, if let's say that today the withholding tax is 12.5%, meaning that if 100 is paid, if 100 is the amount of royalty, 12.5 goes to the government, and 87.5 goes to Win Services UK. Now, is Nigeria a nice, stable country that is going to be reasonably assured of having a 12.5% royalty rate for the next 10 years that we contemplate having a stream of royalties? Maybe, maybe not. You know, who knows? Who knows? But because, you know, I'm a little concerned about, you know, where you're coming from, you know, maybe I don't want to have to worry that next year when the withholding tax changes, that I'm going to end up getting less, or potentially more, but you know, probably less. Because tax rates tend sometimes to go up more often than they go down. Government surprises occasionally. But the point is, when you've been told, if you read the first, I think, 3 pages of the case, not this, just the situation, but the whole thing. If you read the first 3 pages, you have background that Win is in an excess foreign tax credit position for both general category income and passive income. Now, later we'll talk more about what those categories are, but we know they're in an excess foreign tax credit position. If the tax goes up and instead of 12.5%, it goes up to, let's say, 20%, and the net payment goes down to 80, is Win going to receive any extra foreign tax credit benefit for that additional 7.5? Now, the answer is no, because they're in an excess foreign tax credit position. Now, can anybody explain what I mean by excess foreign tax credit position? I'm using an expression, and I don't know yet whether that's something that is meaningful to anybody yet. Glenn, any idea?
Without talking about baskets?
You can forget baskets. I know it's a basket case, but that's a different issue. Yeah, you forget the baskets. Just pretend there's one foreign tax credit limitation. That's it.
You can't take advantage of all the foreign taxes that you've paid. You can't use as a credit all the foreign taxes you've paid. You're limited.
Yeah, exactly. If we go back to that example where we, let's see. If we go back a few slides, assuming the system lets us. Oh, this is not a good sign. It went to the last slide. We're not. We're only on not even to slide 10 yet. Okay, if we looked at this one here, where the foreign tax is 40, we're at 0 U.S. tax. If the country B tax goes to 45 or 50, the U.S. government does not give us a refund. We still have 0 U.S. tax, and that means that we're getting no benefit from additional foreign taxes. And that's an excess foreign tax credit position. Now, the rules allow us to carry back those excess foreign tax credits for 1 year and forward for 10 years. But at least at the moment, that extra tax is giving us no benefit. So if I'm going to license something, and I'm a little worried about the possible withholding tax from the country of the licensee, I might say, look, at the deal I'm making with you is that you will pay me 100. I don't care whether the tax is 1%, whether the tax is 10%, whether the tax is 20%. You will pay me 100 per unit on a net of tax basis. So that's why I might enter into this kind of agreement. I'm not sure about the other country. What about international investors who are buying euro bonds and debt obligations of issuing corporations in various parts of the world? Do you think they, when they invest their money, are thinking about taking foreign tax credits? No, not really. They're expecting a net of tax return. You know, I'm buying a bond, and that bond is going to pay a 5% rate. And I don't care whether there's a withholding tax. I want 5%, period. You've got investors from many different countries buying the same bond, and you know, they don't want to hear about withholding taxes. Probably a lot of them are exempt entities, pension plans, things like that. Probably a good number of them are wealthy people in various countries who are perhaps not declaring what income they're receiving, so they don't care about the foreign tax credit aspect. Maybe they're from countries where foreign income is exempted. But whatever the reason, the reality of the market is that people who buy bonds generally aren't, you know, in these kinds of big issues, they are thinking interest rates on a net of tax basis. So you find this relatively often. Now, the U.S. happens to have some specific rules which tell us that even in that situation, where the payor is economically bearing the tax cost. In other words, if the tax goes up, that person effectively is paying a higher royalty or higher interest payments, or whatever the nature of the payment is. So, again, using that 12.5% and 20% as an example, if we have, for example, a net royalty of 85, forget the 12.5% since this is what's up on the board. If the net royalty is 85 and there's a 15% withholding tax rate, then that will work out to exactly 100 of gross payment. So if the gross payment's 100, the withholding tax, 15% of the gross, is 15, and the net payment is 85. If the withholding rate goes up to, instead of 15%, let's say 20%, now, instead of 100, it's going to be something like 105. The formula will work out 105, let's say. And that company that's making the royalty payment, it's going to cost them more because the royalty, because the withholding rate went up. So the gross royalty is pushed up, and the economic risk, the economic burden of higher tax rates or the benefit of lower tax rates is on the licensee in this case, or the person who's making interest payments. Okay, so we've talked about why you find these things and a few situations where you might find it. The relevance of this for the foreign tax credit is that the U.S. Let's go back over here. The relevance of this for U.S. tax purposes, when WIN is calculating its foreign taxes paid, is that the U.S. says that even though the Nigerian company is the one who's economically at risk for what the rate is, WIN Systems UK Limited is still the taxpayer. They are the taxpayer. And as the taxpayer, at some time in the future, WIN might get the benefit of that foreign tax paid. And again, how WIN might get that in the future we'll eventually get into in our discussion. Now, let's again say that the rate changes to 20%. Okay, because of the net basis, the same number of currency units, whatever it is, whether it's pounds, whether it's dollars, whether it's, whatever they've put in the license agreement as the currency of calculation. If the withholding rate goes up to 20, now there's going to be a higher gross. There's going to be more withholding tax. It's economically borne by the Nigerian company. WIN Services UK Limited is still going to receive the same number of dollars or pounds or, whatever. But as a result of that, when we apply that formula that was up there to figure out what the proper gross income is and the amount of tax, the amount of foreign taxes that WIN Services UK Limited is deemed to have paid is now higher. So the risk is on the Nigerian company. But the legal taxpayer, as far as the U.S. rules are concerned, is still WIN Services UK Limited. Okay, now to try to combine a little bit of what we talked about before with this. Now, we know WIN is the parent company in the United States. It's publicly held, major company, and it happens to have a subsidiary in UK. Now, let's assume that this UK limited company is an eligible entity under the check the box rules. Okay? So WIN has a choice. Will WIN Services UK Limited be treated as a corporation, or will it be treated as a disregarded entity? We don't know. We haven't been given any facts on that. Now, if you look through the questions that follow this particular case study, you'll see that in the questions, it assumes first one way, then the other, because it could be either. Now, first, let's assume it's a disregarded entity. First, let's assume it's a disregarded entity. Okay, so if Wind Services UK Limited is a disregarded entity, who is the taxpayer? Yeah, Win. For U.S. tax purposes, Win is the taxpayer. Now, does that make a difference to us? I don't know how well this will come up, but let's just look briefly at this here. Yeah, it's not so bad. 901A, and what does it say? If the taxpayer chooses to have the benefits of this subpart, subject to the 904 limitation, taxes under this chapter shall be credited with the appropriate amounts in paragraph B, plus, in the case of a corporation, taxes deemed to have been paid under 902. Okay, so there's 901 taxes that are defined. If we go over to B here, B1, okay, the amount of any taxes paid or accrued during the year to any foreign country. Now that's paid or accrued by whom? By the taxpayer. Who is the taxpayer? It's Win up there. Wind Services UK Limited as a disregarded entity is disregarded, if that's our situation. So if Win is considered to be the taxpayer, this is referred to as a direct tax, which is a 901 tax. Now, why does that make a difference? Well, if it's a 901 tax, then Win is the taxpayer. Win is filing a tax return in the U.S. Win is this year paying some amount of foreign tax and this year able to claim a foreign tax credit. So that's something that happens now. If Wind Services UK Limited is not a disregarded entity, but rather is treated as a non-U.S. person, a foreign corporation, and again, for simplicity, we assume it has no U.S. trade or business, it has no U.S. source income that's subject to tax. It's not within U.S. taxing jurisdiction. So it is the one, it's a juridical person, it's a real person, and for U.S. purposes, because we're saying it's a corporation under the check-the-box rules, we see that it is the taxpayer, not Win. Since Wind Services Limited Wind Services UK Limited is not a U.S. taxpayer, not subject to U.S. tax at all, then if it pays any taxes, well, that's not a 901 tax with respect to Win. Win is not the taxpayer. And therefore, no foreign tax credit benefit today for Win. Now, if we look at just this little part here, which is 902, a domestic corporation, which is Win, which owns 10% or more of the voting stock of a foreign corporation, which is Wind Services UK Limited, from which it receives dividends in any taxable year, shall be deemed to have paid the proportion of such foreign corporations' income taxes as, and there's a calculation. So, here, where Wind Services Limited is treated as a corporation, there's no tax benefit okay to Win today in terms of foreign taxes because Win is not the taxpayer. But at some point in the future, when Wind Services Limited pays a dividend, or when its shares are sold, or if it does something that triggers dividend recognition to Win, then 902 grants a deemed paid tax credit. So sometime in the future, maybe Win will receive a benefit from this. So how much tax a foreign subsidiary that's treated as a corporation, how much foreign tax it pays is very important because it will someday affect the U.S. taxation of the parent. Okay, the original subject which got us onto this was who is the taxpayer. But again, there's a bigger picture as to where it fits in. And I hope from this kind of discussion the significance and how it sort of fits together becomes clearer. And again, please, if anything is not clear, ask me. Yes, Glenn.
So under 902 that you just read, deemed paid. So in this case, would you say that Win is the taxpayer because it's deemed to have paid?
Well, I don't think you would ever say that Win is the taxpayer in the way the regulations and the law is structured. I don't think you would ever say that Win itself is the taxpayer. Win is deemed to have paid it, and therefore it can take a foreign tax credit at the time when it is deemed to have paid it. But in a sense, I think if you think of it a little bit as a timing issue, if something's a 901 credit, a direct credit, I've paid the tax today, I get my foreign tax credit this year, period. If my subsidiary, and I say my subsidiary, again, this deemed paid credit rule only applies for U.S. corporate shareholders of foreign companies. Does not apply to individual shareholders. So, again, from a timing point of view, Win, if it's the taxpayer, takes the credit today. If it can't use the credit that 1 year back and 10-year forward carry back starts today and will expire 10 years from now. On the other hand, with the deemed paid credit, if, let's say, the UK company makes a dividend payment 3 years from now, and at that point, because of the dividend, that tax is brought up, and when is deemed to have paid it, then that's the year that it can take the tax into account in its foreign tax credit computation. It's from that year, 3 years out, that we now start counting 1 back and 10 forward. So I think if you think of it as a timing issue, that may help the process. This is what the Guardian case looked like. You had a U.S. parent company, which, as I recall, was a publicly held company. It had a holding company in Delaware for certain of its subsidiaries. And it owned, that holding company owned 100% of GIE, which is the third box there. And that company is the parent, that company, which is incorporated in Luxembourg, was the parent of 3 subsidiaries, all of which were manufacturing companies, actually manufacturing glass. Now, we were talking about this in the context of the check-the-box rules. And the check-the-box rules, of course, allowed the Guardian to, so to speak, check the box for GIE and to treat it as a hybrid entity. So again, what is a hybrid entity? A hybrid entity is one that is a corporation in whatever local country it's formed in. But for U.S. purposes, you ignore that box and treat it as if it were just a branch or a division of whoever the owner is. So in this case, it notes Form 8832 has been filed to check the box on this Luxembourg company, so that that Luxembourg company is treated for tax purposes, for U.S. tax purposes only, not for any other purpose, only for U.S. tax purposes, as a division or branch legally in this fiction that we have in the check the box area. It's, for tax purposes, legally a part of IHC. Now, as a result of that, any income, expenses, credits, anything that is physically within this box is treated as being part of this box here. Treated for U.S. tax purposes only as being part of this box, IHC. And the reason for the green color is to indicate that there is a consolidation in the U.S. where the parent company, the IHC, which includes anything which is inside here, and of course any other members of the affiliated group, which are primarily domestic companies, are included in one consolidated tax return. So, well, before we go to the so, let's now talk about what happens in Luxembourg. In Luxembourg, this company and its 3 subsidiaries were what is called a Luxembourg Fiscal Unitary Group. Fiscal Unitary Group, that's their term for consolidation for tax purposes. Okay, that's fine, that's normal. But the interesting thing here was that under Luxembourg law, although the income and expenses were all down here at this level, Luxembourg law apparently said that this company here, which remember is a real company formed in Luxembourg, respected by everybody in the world except the U.S. tax authorities because of that election, this company here was the one that had the legal obligation to pay the tax. Now notice Guardian checked the box for this one, but not these. So at this level, these are, from a U.S. tax standpoint, foreign corporations. U.S. has no tax jurisdiction, except to the extent that these companies actually have effectively connected income in the U.S. or U.S. source income. And in this case, they don't. So the U.S. has no jurisdiction over what's in these companies. So where are we? What's inside this company is included as part of this box and part of the U.S. consolidation. And this one is the one that has the legal obligation to pay the Luxembourg tax. But the income on which that tax was paid is down at this level in the operating companies, which are outside of U.S. tax jurisdiction. Now, if you remember back to our discussion of who is the taxpayer, we said there were a few criteria where you might be able to say, gee, this person is a taxpayer. Well, one criteria we said was, gee, who earns the income? That's one criteria. But is that the one that is in the U.S. law? No, it's not. It's who has the legal obligation to pay, which is this one, so you can actually have a divergence between who has the legal obligation to pay and who earns the income. Now, when Guardian does its tax returns, it of course fills out a foreign tax credit form, which for the corporation is Form 1116. And it includes those taxes. Now, a little later tonight, we'll talk about foreign tax credit limitation. But assuming that Guardian has the ability to absorb additional foreign taxes because it has a high limitation relative to how much it's paid of foreign taxes, it's able to claim and reduce its U.S. tax to the extent of these taxes, even though the income is not included in the U.S. return. So it's taking taxes on income which it's not reporting and using that to lower the U.S. tax on other income. Now, you might look at this and say, gee, this doesn't make a lot of economic sense. Why does the U.S. allow it? And again, I think I said last week, interestingly enough, it has been this way literally for 97 years. give or take, well, maybe not 90, but let's say 90 years since the early 1920s up until now. The point is that finally in 2010 we have a code section to deal with this issue that attempts to avoid this problem of having the foreign tax but not reporting the income. So this was enacted in August as part of the Education, Jobs, and Medicaid Assistance Act, and it's something which is brand new to us. An interesting thing is that they're not trying to change the basic rule that says that the taxpayer is the person with legal liability. They're not changing that basic rule. But what they are doing is creating a mechanism to delay the recognition of the foreign tax until there's a matching of income that created that tax being in the U.S. tax return. So this becomes a delay of the ability to claim the foreign tax credit. Here's a couple of examples of what this is contemplating. This is just two examples. It's been written to be much broader than just this. This is the guardian situation where you have a disregarded entity between the parent and the controlled foreign corporation, for example, in this case, that is actually conducting activities. So in this kind of thing, again, guardian, actual income and expenses in a foreign corporation which is recognized as a foreign corporation, but because of a foreign consolidation, the company in the middle, which is elected check-the-box status, the tax is at this level, and as a result is included because of the disregarded entity status in the as a credit of the parent. Again, your guardian situation. This is one thing that this new rule affects. And what it essentially says is until this one pays a dividend or has some sort of constructive dividend or is hit with an inclusion in income, for example, under Subpart F, which we'll get to later on in the course, until something happens that causes that income to be recognized within the U.S. corporate solution, then there's no ability for the parent and the group to use that foreign tax credit. It's suspended until the income has been recognized. Anybody remember what this is supposed to be? Yeah, reverse hybrid. Okay, and what's a reverse hybrid with the triangle pointed down? It's a corporation for which purposes? U.S. or foreign? Anybody want to try again? U.S. Okay, so it's a corporation for U.S. purposes, but is either a partnership or somehow transparent for foreign purposes. So it's the opposite of a hybrid. Hybrid is usually then a corporation under local law, but disregarded, or a partnership for U.S. purposes. So here it's the opposite. So the point is, if you have something which is a flow-through flow-through vehicle for purposes of local taxation, well, maybe the owner has the legal liability for tax. If it's flow-through for local purposes, then under those local rules, likely the owner is the one with legal liability for tax. But, of course, if the U.S. parent has made sure that this is to be treated as a corporation, then it has legal liability for the tax, but the income and expenses are down here inside corporate, foreign corporate solution, and therefore outside of the taxing jurisdiction of the U.S. So again, until there is a realization here by virtue of some kind of distribution or subpart F income inclusion or something, those taxes for which this one is the legal taxpayer are not recognized. So those are some examples of this new rule. Okay, so what categories of taxpayers can claim foreign tax credits? For the most part, what we're going to be seeing is, of course, individuals and U.S. corporations. That's what I'm referring to as the usual suspects. However, be aware that it also applies, very much for non-residents and foreign corporations, to the extent that they have effectively connected income. Again, this is an inbound item, so to speak, as opposed to an outbound item. But this can happen. Any quick example as to how you might have a foreign tax where there's effectively connected income such that say, foreign corporation that has the effectively connected income such that it needs a foreign tax credit? Is there any simple example we can use to hopefully make it more visible? How about a Japanese bank which has an office in Seattle? Do you think such a bank might ever loan money to somebody in Canada? The work's done by credit officers that are located in Seattle. The, so to speak, capital of the branch in Seattle is being used, and at least under banking regulations, for making sure that the bank is adequately capitalized. It's thought of as coming out of capital that's the U.S. branch is responsible for. So there could be a Canadian withholding tax on the interest. So you have a business of a Japanese bank being conducted in Seattle. It earns interest from Canada. There's a withholding tax. So that kind of situation is certainly not uncommon. This is kind of interesting that the rules give you a year-by-year choice. You can either deduct foreign taxes or you can choose to credit, take the credit. Now, as we'll talk about more later on, yeah, it usually is going to make sense to take the credit. But you do have quite a bit of time, and notice it says when must the choice be made? And it's 10 years from the due date of the tax return for the year in which the foreign tax credit is claimed. Why give so much time? What's the normal, so to speak, statute of limitations for making changes to a tax return? Yeah, 3 years. So why grant 10 years?
It seems like it has something to do with the amount of time you have to carry back losses. Is that right?
A good thought, but not exactly. You can carry back. The carryback periods have changed over time, but normally it's just been like 1, 2, or 3 years for carryback. So that's really not it. Do things move swiftly when you, for example, have disputes or discussions with tax authorities about how much you owe? It takes forever. I mean, it just drags on and on and on. And if you think it's bad in this country, it can be even worse in some other countries. So if you have a situation, especially, for example, in the transfer pricing area, a situation where there's a big difference in how much foreign tax is going to be due because that other government is questioning your transfer pricing, and it takes you 6 months to get a economic report of how to justify your transfer pricing, and it probably takes another 6 months for the local tax authorities to read it. That's assuming that it hasn't taken another 6 months to translate it. Anyway, this drags on, and if there's any litigation involved, then it just goes year by year by year. It takes forever. There can also be, again, which we'll probably talk about later, competent authority discussions, where you get the tax authorities of the two countries involved to talk to each other. When they do eventually get together, do you think they speak quickly to each other, or do you think they draw out every word to slow the process? Well, whatever it is, the average is like 2, 3, 4 years for these kinds of mechanisms to go through their procedures. So this 10 years actually does make a certain amount of sense, because to actually finalize how much tax there will be might take that long. If you look at a lot of the tax cases you read for the United States here, not necessarily for this course, but for other courses in the school, very often the case is, let's say, decided in 1985 and involves the years from the early 1970s. That's perfectly normal. It takes a long time. So 10 years is what we find. Now, I think I've already said this a few times, so we'll go through these slides rather quickly, and that's that, again, a dollar for dollar benefit is what the foreign tax credit gives you. And a deduction is not worth dollar for dollar. A deduction is only worth the tax rate, the marginal tax rate, times the amount of the deduction. So a deduction is just not worth as much. Now, admittedly, this doesn't happen too often, but there can be situations where you might want to choose the deduction. as opposed to the credit. Another aspect which is kind of interesting is, and this is just to keep in, so to speak, the back of your minds as part of the environment we're in, and that's that there's different carry back and carry over periods for foreign tax credits and net operating losses. Today, where we have a 10-year carry forward for the foreign tax credit, 10 years is a long time. You have reasonable hopes of maybe making income in the foreseeable future and hopefully being able to use your excess credits. This was, in a sense, a bigger issue before in years past because you had, for example, on net operating losses, 3 years back, 7 years forward, and on foreign tax credits, 2 years back and 5 years forward. And where 5 years can go by very, very quickly. Maybe you don't realize that, but some of us do realize that the time can go rather quickly. So the point is, this part is less of an issue, but keep in mind that it's there. This play of, well, gee, am I going to be able to reasonably make enough money to use those excess foreign tax credits? Would I be better off having losses which last longer? So this is one aspect. This last one, 901M, that's another one which just came in August of this past year. Does anybody, let's see, I think a lot of you have taken the corporate course. Does anybody remember anything about Section 338?